Question 1. Scenario-based. Mr. Thompson, a 45-year-old non-smoker with no significant medical history, recently applied for a 20-year term life insurance policy. He was initially quoted a premium of $75 per month, but after the underwriting process, the premium was increased to $120 per month. Which of the following is the most likely reason for the increase in premium after underwriting? A. Mr. Thompson's age group automatically qualifies for a higher premium. B. The underwriting process revealed high health risks that were not accounted for initially. C. Mr. Thompson opted for an accidental death benefit rider after receiving the original quote. D. The insurance company made an error in the initial quote. Answer. B. Explanation. In the underwriting process, insurance companies assess an applicant's risk factors such as health status, lifestyle, and occupation. Even though Mr. Thompson has no significant medical history, underwriting may reveal additional risk factors such as minor health issues or changes in his lifestyle that were not disclosed or considered in the initial quote. Connecticut law allows insurers to adjust premiums after underwriting based on the individual risk factors. Option A is incorrect because age is already factored into the original quote. Option C could lead to a slight increase, but such riders would generally not result in this significant a premium jump unless explicitly chosen by the policyholder. Option D is less likely as underwriting results are based on risk assessment, not an administrative error. Question 2. Which of the following options is the best benefit of a convertible term life insurance policy? A. The policyholder can convert the term policy into a permanent policy without evidence of insurability. B. The policyholder can increase the face value of the term policy without additional premiums. C. The policyholder is guaranteed the same premium rate for both the term and the permanent policy. D. The policyholder can extend the term beyond the original expiration date without renewing. Answer A. Explanation. Convertible term life insurance allows a policyholder to convert their term policy into a permanent policy without needing to provide evidence of insurability, such as a medical exam. This is beneficial for individuals whose health may decline over time, enabling them to obtain long-term coverage at rates set when the term policy was originally purchased. Option B is incorrect because increasing the face value of a policy typically results in higher premiums. Option C is incorrect as the premium rate for the permanent policy is generally higher than that of the term policy. Option D is incorrect because conversion does not extend the term policy, it transforms it into a permanent one. Question 3. A term life insurance policy with a waiver of premium rider will A. Cancel the policy if the insured becomes disabled. B. Suspend premium payments if the insured becomes disabled and cannot work while maintaining coverage. C. Increase the face value of the policy if the insured becomes disabled. D. Only apply if the insured dies as a result of a disability. Answer B. Explanation. A waiver of premium rider allows the policyholder to maintain coverage without paying premiums if they become disabled and are unable to work. This ensures that the term policy remains active despite the inability to make premium payments due to disability. Option A is incorrect because the policy is not cancelled. Rather, premiums are waived while coverage continues. Option C is incorrect as the rider does not increase the face value of the policy. Option D is incorrect because this rider applies during disability, not specifically related to death as a result of disability. Connecticut insurance regulations support the use of this rider to protect the insured during financial hardship caused by disability. Question 4. In Connecticut, which of the following actions is required during the free look period for a term life insurance policy? A. The insurer must refund the entire premium paid if the policy is cancelled within the free look period. B. The policyholder must provide proof of a valid reason for cancelling the policy to receive a refund. C. The policyholder must pay a cancellation fee to receive a partial refund of the premium. D. The policy cannot be cancelled once the insured has been medically underwritten and accepted by the insurer. Answer A. Explanation. Connecticut law mandates that term life insurance policies include a free look period which allows the policyholder to cancel the policy for any reason and receive a full refund of the premium. This period is typically 10 days or longer depending on the insurer. Option B is incorrect because no specific reason is required for cancellation. Option C is incorrect as no cancellation fee is imposed. Option D is also incorrect because the free look period applies regardless of underwriting status. Question 5. Scenario-based. Ms. Walters has a 10-year renewable term life insurance policy and is approaching the end of the policy term. She is now 50 years old and her health has deteriorated since she first purchased the policy. What will likely happen if she decides to renew the policy? A. Ms. Walters' premium will remain the same as it was when she first purchased the policy. B. Ms. Walters will need to undergo a new medical exam to determine her insurability. C. Ms. Walters will be able to renew the policy, but the premium will increase based on her age at renewal. D. Ms. Walters cannot renew the policy because of her deteriorated health. Answer: C. Explanation. A renewable term life insurance policy allows the policyholder to renew the coverage without providing proof of insurability, meaning Ms. Walters does not need a new medical exam. However, the premium is recalculated based on her age at the time of renewal, which will likely result in higher premiums due to her age and health changes. Option A is incorrect because the premium will increase with age. Option B is incorrect because a new medical exam is not required for renewal. Option D is incorrect because health status does not affect the renewal of a renewable term policy, although it may impact premiums if re-underwritten. Question 6. Which of the following is true about the contestability period in a term life insurance policy? A. The insurer can deny a death benefit claim if the insured dies at any time due to an omission or misstatement on the application. B. The insurer can contest the policy only within the first 2 years after the policy is issued. C. The insurer can contest the policy at any time if the death occurred due to suicide. D. The contestability period allows the insurer to raise premiums at any time during the first 2 years of the policy. Answer: B. Explanation. The contestability period in most life insurance policies, including term life insurance, is generally 2 years from the date the policy is issued. During this time, the insurer can investigate and potentially deny a claim if it discovers that the insured misrepresented information or made omissions on the application. After this period, the policy is typically incontestable except in cases of fraud. Option A is incorrect because the insurer cannot deny claims indefinitely. The contestability period limits this to the first 2 years. Option C is incorrect because a separate suicide cause generally limits claims related to suicide, not the contestability period. Option D is incorrect because the contestability period does not allow for changes in premiums. Question 7. Which of the following statements about a return of premium rider in a term life insurance policy is true? A. The policyholder will receive a refund of all premiums paid if they survive the policy term. B. The death benefit is reduced if the return of premium rider is added to the policy. C. The return of premium is only available for policies that have cash value. D. The premiums for a policy with a return of premium rider are lower than for a standard term policy. Answer: A. Explanation. A return of premium rider ensures that the policyholder receives a refund of all premiums paid if they outlive the term of the policy. This rider typically makes the policy more expensive, but it provides the benefit of recouping costs if the insured survives. Option B is incorrect because the death benefit is not reduced by the rider. Option C is incorrect because ROP applies to term life insurance, which does not accumulate cash value. Option D is incorrect as policies with an ROP rider are generally more expensive due to the added benefit. Question 8. In Connecticut, when an individual buys group term life insurance through their employer, which of the following is true? A. The employer determines the beneficiary of the policy. B. The coverage amount is usually based on the employee's salary or position. C. The policyholder must pay the entire premium out of pocket. D. Group term life insurance policies are always convertible to individual policies. Answer: B. Explanation. Group term life insurance through an employer typically bases the coverage amount on an employee's salary or position. This allows for easy calculation of coverage limits and is a common practice for employee benefit plans. Option A is incorrect because the employee designates the beneficiary. Option C is incorrect as group term policies are often subsidized by the employer, with the employee covering only a portion of the premium, if any. Option D is incorrect because not all group term policies are convertible to individual policies, though many offer that option. Question 9. Which of the following is most likely to result in a higher premium for a term life insurance policy? A. The insured is 35 years old and has a family history of heart disease. B. The insured is a non-smoker with no pre-existing health conditions. C. The insured purchases a 5-year term policy instead of a 20-year term policy. D. The insured opts for a policy with no additional riders or endorsements. Answer A. Explanation. A family history of heart disease is considered a higher risk factor by insurers, which can result in a higher premium. Health issues, including family medical history, play a significant role in the underwriting process and can raise the cost of coverage. Option B is incorrect because a healthy non-smoker typically qualifies for lower premiums. Option C is incorrect because shorter-term policies like a 5-year term generally result in lower premiums than longer-term policies like a 20-year term. Option D is incorrect because a policy with no additional riders is typically less expensive. Question 10. Which of the following best describes the accelerated death benefit rider in a term life insurance policy? A. It allows the policyholder to receive a portion of the death benefit early if diagnosed with a terminal illness. B. It provides an additional payout in case of accidental death. C. It allows the insured to extend the policy's term without additional medical underwriting. D. It waives premiums if the insured becomes disabled. Answer A. Explanation. The accelerated death benefit rider allows the policyholder to access a portion of the death benefit early if they are diagnosed with a terminal illness. This benefit helps cover medical expenses or other costs associated with the illness. Option B describes an accidental death rider, which is a different type of rider. Option C refers to renewability provisions, and Option D refers to a waiver of premium rider. Question 11. Which of the following is a common disadvantage of a term life insurance policy? A. The premium is fixed throughout the term of the policy. B. The policy provides lifelong coverage if renewed annually. C. The policy does not build cash value. D. The policyholder can convert it to whole life insurance at any time. Answer C. Explanation. A major disadvantage of term life insurance is that it does not build cash value. Unlike whole life or universal life insurance policies, term insurance only provides a death benefit and has no savings or investment component. Option A is an advantage, not a disadvantage. Option B is incorrect because term policies do not offer lifelong coverage without renewal, and Option D is incorrect as conversion options depend on the policy terms and are not available in all cases. Question 12. In Connecticut, which of the following tax implications applies to life insurance proceeds paid out to a beneficiary? A. The proceeds are subject to federal income tax. B. The proceeds are subject to Connecticut state income tax. C. The proceeds are generally not subject to federal or state income tax. D. The proceeds are always taxed if the policyholder passes away within 2 years of purchasing the policy. Answer C. Explanation. Life insurance death benefit proceeds are generally not subject to federal or state income tax, including in Connecticut. This makes life insurance an attractive option for financial planning and providing for beneficiaries. Options A and B are incorrect because life insurance payouts are not typically taxed as income. Option D is incorrect as the timing of death does not affect the taxability of the proceeds. Question 13. Which of the following best describes a convertible term life insurance policy? A. A policy that allows the insured to convert a portion of the death benefit into an annuity. B. A policy that can be converted into a permanent life insurance policy without providing evidence of insurability. C. A policy that can be converted into a joint life policy covering 2 individuals. D. A policy that provides increasing death benefits over time without premium increases. Answer B. Explanation. A convertible term life insurance policy allows the policyholder to convert the policy into a permanent life insurance policy such as whole life or universal life without having to provide evidence of insurability such as a medical exam. This feature is beneficial if the policyholder's health has deteriorated. Option A refers to annuities, which are not typically part of term policies. Option C is incorrect as convertibility refers to converting into a permanent policy, not a joint life policy. Option D describes an increasing term policy, not a convertible one. Question 14. If an insured in Connecticut dies within 2 years of purchasing a life insurance policy, the insurer can deny the claim under which circumstance? A. The insured misrepresented a material fact on the application. B. The insured died of natural causes. C. The policy was issued as a guaranteed issue life insurance policy. D. The insured died in an accident unrelated to their health. Answer A. Explanation. During the contestability period, typically 2 years after the policy is issued, the insurer can investigate the application and deny claims if it finds that the insured misrepresented a material fact, e.g., undisclosed health issues. After the contestability period, The policy generally becomes incontestable except in cases of fraud. Options B, C, and D are incorrect because the cause of death or type of policy does not impact the contestability period. Question 15. In Connecticut, which of the following is true regarding the waiver of premium rider in a term life insurance policy? A. It waives the premium payments if the policyholder loses their job. B. It waives the premium payments if the policyholder becomes permanently disabled. C. It waives the premium payments if the policyholder is diagnosed with a terminal illness. D. It waives the premium payments if the policyholder misses payments due to financial hardship. Answer B. Explanation. A waiver of premium rider waives the policyholder's premium payments if they become permanently disabled and are unable to work. This ensures that the policy remains in force even if the insured cannot continue making payments due to disability. Option A is incorrect because unemployment is not typically a qualifying event for the waiver. Option C refers to an accelerated death benefit rider, not a waiver of premium. Option D is incorrect because financial hardship alone does not qualify for this waiver. Question 16. Which of the following is true about level term life insurance? A. The death benefit decreases each year while the premium remains the same. B. The premium remains the same throughout the term, but the death benefit increases annually. C. Both the death benefit and the premium remain the same throughout the term. D. The policy automatically converts to whole life insurance at the end of the term. Answer C. Explanation. Level term life insurance provides a fixed death benefit and fixed premium throughout the term of the policy, making it predictable and affordable for policyholders. Option A describes a decreasing term policy. Option B is incorrect as neither the death benefit nor premium increases in a level term policy. Option D is incorrect because term policies do not automatically convert to whole life insurance unless specifically stated in the policy's convertibility clause. Question 17. Which of the following is true regarding the grace period in a term life insurance policy? A. The policyholder has 90 days to pay a missed premium before the policy lapses. B. The policyholder has 31 days to pay a missed premium during which the policy remains in force. C. The grace period allows the policyholder to reinstate a lapsed policy without paying back premiums. D. The policyholder can extend the grace period indefinitely with the insurer's permission. Answer B. Explanation. In most term life insurance policies, including those in Connecticut, the grace period is typically 31 days, during which the policyholder can pay a missed premium without the policy lapsing. During this period, the policy remains in force and the insurer will pay out the death benefit if a claim is made. Option A is incorrect as 90 days is too long for a typical grace period. Option C is incorrect because reinstatement requires payment of all past due premiums. Option D is incorrect because the grace period cannot be extended indefinitely. Question 18. What is the primary benefit of adding an accidental death rider to a term life insurance policy? A. It guarantees the policyholder will receive a refund of all premiums paid. B. It increases the death benefit if the insured dies due to an accident. C. It allows the policyholder to receive early payments if they become terminally ill. D. It waives all premiums if the policyholder is injured in an accident. Answer B. Explanation. An accidental death rider increases the death benefit payout if the insured dies as a result of an accident, often doubling the benefit. This rider is typically affordable and provides extra protection for families in the event of a sudden accidental death. Option A refers to a return of premium rider. Option C refers to an accelerated death benefit rider, and option D refers to a waiver of premium rider, none of which are related to accidental death coverage. Question 19. Which of the following is true about increasing term life insurance? A. The premium remains the same while the death benefit increases over time. B. Both the premium and death benefit increase over time. C. The death benefit remains the same, but the premium decreases over time. D. Increasing term life insurance is always convertible to whole life insurance. Answer A. Explanation. In increasing term life insurance, the death benefit increases over time while the premium remains the same. This type of policy can be beneficial if the policyholder wants coverage that grows to match inflation or increase financial responsibilities. Option B is incorrect because premiums typically remain fixed. Option C describes a decreasing premium policy, not an increasing term policy. Option D is incorrect as convertibility depends on the policy terms. Question 20. Scenario based. Mr. Smith is 45 years old and has purchased a 20-year term life insurance policy to cover his mortgage and other debts. He is concerned that if his financial situation changes, he may need to increase his coverage. What option might be available to Mr. Smith during the policy term? A. He can automatically increase the death benefit without additional underwriting. B. He can add a guaranteed insurability rider, which allows him to increase coverage at specific points without medical underwriting. C. He can convert his term policy into a whole life policy and increase the premium to match his coverage needs. D. He cannot change the coverage amount once the policy is in force. Answer: B. Explanation: a guaranteed insurability rider allows Mr. Smith to increase the death benefit at certain points, such as at specific ages or life events like the birth of a child or marriage, without additional medical underwriting. This rider ensures that Mr. Smith can increase his coverage if his financial obligations grow, even if his health deteriorates in the future. Option A is incorrect because term policies generally do not allow automatic increases without a rider. Option C refers to converting a term policy to a permanent one, but that does not guarantee an increase in coverage. Option D is incorrect because coverage can be changed with a rider like the guaranteed insurability option. Question 21. In Connecticut, if a term life insurance policy lapses due to non-payment, what options might the policyholder have to reinstate the policy? A. The policyholder can reinstate the policy within 5 years without providing evidence of insurability. B. The policyholder must pay all past due premiums with interest and provide evidence of insurability within a specified period. C. The policyholder can reinstate the policy by paying a penalty fee within 90 days, regardless of health status. D. The policyholder must reapply for a new policy without the option to reinstate. Answer: B. Explanation. In Connecticut, a lapsed policy can often be reinstated within a certain time frame, typically 3 to 5 years, if the policyholder pays back all missed premiums with interest and provides evidence of insurability. Option A is incorrect because most insurers require evidence of insurability for reinstatement. Option C is incorrect as there is no provision for reinstatement through just a penalty fee without health assessment. Option D is incorrect because reinstatement is typically an option before requiring a completely new application. Question 22. Which of the following factors would most likely result in a higher premium for a Connecticut term life insurance policyholder? A. A 25-year-old non-smoker with no health issues. B. A 40-year-old smoker who engages in high-risk activities such as skydiving. C. A 35-year-old with a clean health record and no dangerous hobbies. D. A 30-year-old who occasionally drinks alcohol socially but has no health complications. Answer: B. Explanation. Premiums for term life insurance are influenced by factors such as age, health, smoking status, and participation in high-risk activities. A 40-year-old smoker who skydives would be classified as a higher risk due to both smoking and dangerous hobbies. This would result in significantly higher premiums. Options A, C, and D represent low-risk categories. Question 23, scenario-based. Mrs. Rodriguez is considering adding a waiver of premium rider to her 15-year term life insurance policy in Connecticut. If she becomes disabled during the policy term, how will the rider benefit her? A. The rider will allow her to take a loan against the policy's future death benefit to cover her expenses. B. The rider will provide her with a monthly disability income until the term expires. C. The rider will waive all future premium payments while keeping the policy in force if she becomes totally disabled. D. The rider will automatically convert her term policy into a whole life policy. Answer: C. Explanation. A waiver of premium rider waives future premiums if the policyholder becomes totally disabled, ensuring the policy remains in force without additional payments. Option A is incorrect because term life policies generally do not allow loans against death benefits. Option B refers to a disability income rider, which is a different product. Option D is unrelated as the waiver of premium rider does not convert a term policy to a whole life policy. Question 24. Under Connecticut law, how long is the contestability period for term life insurance policies during which the insurer may contest or deny claims based on misrepresentation? A. 6 months. B. 1 year. C. 2 years. D. 5 years. Answer: C. Explanation. The contestability period for life insurance policies in Connecticut is typically 2 years from the date the policy is issued. During this time, the insurer may contest claims if they discover material misrepresentations or omissions in the application. After this period, claims generally cannot be denied on these grounds. Options A, B, and D are incorrect. Question 25. Which of the following policy features would most likely allow a Connecticut policyholder to extend coverage at the end of a term without providing new evidence of insurability? A. Level term rider. B. Convertibility option. C. Guaranteed renewable option. D. Non-renewable policy clause. Answer: C. Explanation. A guaranteed renewable option allows the policyholder to renew the term policy at the end of its term without the need for additional medical underwriting. However, premiums will generally increase based on the insured's age at renewal. Option B allows conversion to a permanent policy but not renewal of the term. Option A is not relevant to renewal, and Option D refers to policies that cannot be renewed. Question 26. Which of the following is an exclusion that could prevent the payout of a Connecticut term life insurance policy's death benefit? A. The insured dies due to illness during the contestability period. B. The insured dies while participating in a hazardous activity not disclosed on the application. C. The insured dies in an accident during the policy's grace period. D. The insured dies from natural causes after the term expires. Answer: B. Explanation. If the insured dies while participating in a hazardous activity like skydiving or scuba diving that was not disclosed during underwriting, the insurer may deny the death benefit due to material misrepresentation. Option A is incorrect because illness generally does not lead to a denied claim unless there was a misrepresentation. Option C would not cause a denial if the premium is paid during the grace period. Option D is incorrect because the policy is no longer in force after the term expires. Question 27, scenario-based. John is 50 years old and has just purchased a 10-year level term life insurance policy in Connecticut. 5 years into the policy, John is diagnosed with a terminal illness. His policy includes an accelerated death benefit rider. How can this rider assist John? A. It will waive all remaining premiums for the policy. B. It will allow John to convert his term policy into a whole life policy. C. It will provide a portion of the death benefit to John while he is still alive. D. It will automatically renew the policy for another 10 years without underwriting. Answer: C. Explanation. An accelerated death benefit rider allows the insured to receive a portion of the death benefit early if they are diagnosed with a terminal illness. This money can be used to cover medical expenses or other costs. Option A refers to a waiver of premium rider. Option B refers to convertibility, and Option D refers to a renewal provision, neither of which applies to accelerated benefits. Question 20. Which of the following premium structures is common in a term life insurance policy where the premiums remain constant throughout the term? A. Increasing term premium. B. Decreasing term premium. C. Level term premium. D. Variable term premium. Answer: C. Explanation. A level term premium structure ensures that premiums remain the same for the entire duration of the policy. In contrast, increasing term premiums rise over time, and decreasing term refers to the death benefit decreasing, not the premium. Variable term premium options do not exist in standard term life insurance policies. Question 29. In Connecticut, if a policyholder elects a return of premium ROP term life insurance policy, what happens at the end of the policy term if no claim is made? A. The policyholder receives a refund of all premiums paid over the life of the policy. B. The policyholder can extend the policy at no additional cost. C. The policyholder receives a partial refund of the premiums paid. D. The policyholder's death benefit automatically converts to a whole life policy. Answer A. Explanation. A return of premium ROP term life policy provides a refund of all the premiums paid if the policyholder survives the term. This feature increases the cost of the policy but provides a form of savings if no death benefit is claimed. Options B, C, and D are incorrect as they do not describe how ROP policies work. Question 30. Which of the following is not a factor typically considered in the underwriting process for Connecticut term life insurance policies? A. Age of the applicant. B. Health status and medical history. C. Annual income of the applicant. D. Applicant smoking habits. Answer: C. Explanation. While factors such as age, health, and smoking habits are critical to the underwriting process, the applicant's annual income is generally not directly considered when determining insurability or premium costs. Income may be relevant to determining the amount of coverage needed, but it does not affect underwriting decisions.